a lot of different characteristics and skills that are required to be successful. Most people put a lot of emphasis on strategy, entries, picking assets, and timing the market. And sure, these things are extremely important. But do you want to know what the most important aspect of building real long-term wealth is? It's learning to control your emotions. Because if you can't control your emotions, there will come a day when you lose big. I've seen it before, and I'm sure I'll see it again. It's scary, but it's true. I want you to be the absolute best trader that you can be. So I can't pull punches. I have to tell you the truth. And the truth is that controlling your emotions and making the emotional cycle of trading and investing work for you, not against you, is exactly what separates successful traders from rookies. So what is trading psychology? When we talk about trading psychology, we're referring to the emotional and mental states that are heavily involved when someone engages in trading the markets. Trading psychology refers to various aspects of an individual's character, their behavior, and their emotional dispositions that influence their actions. So discipline and risk-taking are two of the most critical aspects of trading psychology. And it's easy to see why trading can be difficult when, for a start, the two largest components of trading are actually contradictory ideas. Someone that is usually disciplined is often not a risk-taker, and vice versa. Therefore, it is the act of balancing these two opposing forces that we will focus on for the majority of our time here. So, now that we've covered the two underlying forces, let's talk about the emotions associated with them: fear and greed. You can't pick up a book on trading without seeing these two emotions accounted for, and there's a really good reason for that. From an evolutionary perspective, these are two of our strongest emotions. They made sure we had what we needed to survive and thrive, and they kept us safe. And yet here we are as traders expected to battle both of them at the same time. Greed is not only an excessive desire for more wealth, it's just a desire for more of everything. So greed really knows no boundaries, and it's the people that don't consciously control it that see it take over their lives and run their lives for them. So it causes traders to stay in winning positions for so long that those positions turn into losers. It stops people from selling and taking profits even when they know the market is likely to turn against them. It convinces you to take on large speculative positions and essentially gamble your money in the hope of those extreme returns. So greed is most apparent in the final phases of a bull market. As you saw in November and December 2017, the emotion of greed is a really, really strong one. It's extremely intense. People got so caught up then in their greed that they couldn't see anything else. They couldn't see the possibility of losing money. All they could see and all they dreamed about were the endless gains. Now, I'd be lying if I said that I didn't feel it too. Everybody did. But being self-aware is key. If you know you're feeling greed, you can take appropriate measures to make sure it doesn't take over and destroy your trading. So next, let's talk about fear. I think the best way to combat fear is to really understand it. The Harvard Dictionary defines fear as a distressing emotion aroused by impending danger, evil, pain, etc., whether the threat is real or imagined. Now, I love that definition because it holds the keys. The secret is right there, whether the threat is real or imagined. Your job isn't to never be afraid. That's impossible. Your job is to discern the real from the imagined. It's as simple as that. When everyone's freaking out, you can keep your composure, refer to your trading plan and trading rules, and if you can do that, you have nearly unlimited potential. Fear is one of the strongest human emotions. It's responsible for a large part of our survival all this time. You have to remember that we're living in 30,000-year-old bodies, built to discern predators from prey and evaluating real life-threatening situations. But since we're lucky enough not to have our lives in constant danger, our brain has to reevaluate our surroundings and decide what is now classified as life-threatening. What's the new life-threatening? Studies have shown that losing money causes the same mental anguish as torture, and our brains actually perceive the loss of money as a threat to our safety and a threat to our lives. So when you understand these things, it starts to become easier to understand why exactly fear plays such a disruptive role in investing and trading. Add to that our tendency to weigh losses more heavily than equal gains, the concept of loss aversion, and you start to understand why making clear decisions is difficult at the best of times and nearly impossible at the worst of times. Honestly, we just aren't built for trading. We're not built for that kind of activity because it goes against a lot of our fundamental principles that make up human nature. Now, I want to talk about one of the most prolific examples of these two emotions working together against the trader. And I'm sure most of you have actually felt this before and gone through it personally, and you'll be able to relate to the story that I'm about to tell. So firstly, you jump on Binance and you open a trade that you're really confident about. It's a sure thing, and it looks good at the start. Sometimes it looks really good. The position might be up 50% or 100% or 200%, but something inside you is saying that it will still go higher. So you don't sell, you don't lock in any profits, and then it moves against you. And that's fine, you say. This will be a small pullback before we keep going. At worst, I'll sell when it gets back to the highs and cash out my profits right at the top and make tons of money. But all of a sudden it starts dropping, and now it's dropping even faster. Now, a very small part of you realizes that it might not ever make it back to those highs, but it's already down so much so quickly, and you feel the pain of the loss that you could have had, and that hurts. So you're split in half. Greed's wanting you to hold on so you can sell back at the top and get out with those large profits you could have had earlier. And fear is telling that you probably should sell now and just get out because it went down quickly and it hurts. But since you're still well in the green at this stage, it's the greed that has the last say, and the vote is to hold on. So the next day you wake up and the position is down even further. This time it's down a lot further. Now all of those gains are actually gone and you're in the red. You can feel it in your body. Your stomach tightens, your chest tightens, and you feel a really real feeling of pain and anguish. You say to yourself, oh, it hurts, but it's okay. I'll wait for the next bounce and I'll sell then and I'll get out even and I'll just forget about this whole thing. The market starts to rally again and you get your hopes back up, but it never gets back to your entry level. And then all of a sudden it plummets. Now the pain is really real. It's physical. You can feel it in your body. It hurts. Everything is tight and everything feels just bad. You hold on for as long as you can, but eventually you sell at a very large loss just to make that pain stop. The exact same cycle plays out in the short term during each day and the longer term over weeks, months, and even years. This cycle is the basis of the emotional market cycle. So, what is the emotional market cycle? A lot of you will be familiar, but we'll go over it again. So, stage one is the up. Investors all start with optimism. We commonly expect things to go our way, or we tend to expect a return for the risk of investing. As expectations are met, it's common to get excited about the possibility of even greater returns, and the excitement becomes thrilling as those returns begin to exceed our actual expectations. And this is about the time when greed enters the scene and starts to kick in. Now, at the top of the cycle is when investors experience euphoria, and greed is now completely in control. It's almost impossible to believe that what is happening will not continue forever, and your memory has been almost completely wiped of any past negative experiences. But it's here where investors are at the point of maximum financial risk. When we believe that everything we touch turns to gold, we fool ourselves into believing that we can beat the market forever, that the market will keep rising, that we cannot make any mistakes, and that excessive returns are now commonplace, and that we can bet bigger and tolerate higher levels of risk. Stage 2, the break. The second phase of the cycle occurs when the market stops meeting our new lofty expectations and it begins to turn. At first, we anxiously watch the market for any signs of direction. Anxiety turns into denial and then quickly fear as the value of our investments decline. Many people will start to act defensively and may think about switching out of riskier assets to more defensive positions or even out to cash. About half of the market participants are still driven by greed of what they could have had, and the other half have now succumbed to fear of the sharp drop. Now, the drop is the third phase of the cycle. The realities of a bear market come to the fore, and an investor may become desperate, afraid, and angry. Many panic and withdraw from the market completely, afraid of further losses. Those who persevere become despondent and wonder whether the markets are ever going to fully recover, and they wonder if they should even be there at all. Others completely detach emotionally from the market as a coping mechanism, outsourcing decision-making to, well, nobody. And then the final group are the ones that got in early and they're really committed now. They're just holding on for dear life, battling fear every day until the majority of those people cave in and usually sell at the bottom at the same time. Now, stage 4 is recovery. In the fourth stage of the cycle, investors may experience some skepticism when the markets start to rise. They often have a sense of caution or worry, wondering if the market growth will last. They've been hurt before, and they might be reluctant to invest money in the market at a point when prices are still relatively low and opportunities are actually still attractive. Now, this is the second best time to invest from a pricing perspective, and is also the number one safest time to invest or add to those existing positions as the trend becomes bullish. I'm sure a lot of you have seen these graphs before and perhaps even heard them explained. For me, the emotional market cycle is one of the market's many gifts, because acting counter to the emotional trend with patience while following objective trading rules and your journal is one of the most effective ways to profit from other traders' misfortunes. It isn't usually until we go through our first complete cycle that we fully understand its power and the sheer magnitude of what it can do. The emotional market cycle has been destroying trading accounts since the markets were invented. What we need is a plan, a set of rules, and a strategy to not only avoid falling prey to the market cycle, but to rise above it completely and use it to our advantage. Now that we've talked about the basis of these emotions and apply them to the emotional market cycle, we need to dive deeper into exactly how these emotions manifest themselves every day and what trading actions they force us to take or inhibit us from taking when we need to the most. Fear of being stopped out or fear of taking a loss. The usual reason for this is that the trader fears failure and feels like he can't take another loss. The trader's ego here is at stake. Getting out of trades too early. Relieving anxiety by closing a position. Fear of position reversal and as a result, feeling let down. The need for instant gratification. Wishing and hoping. Not wanting to take control or responsibility for the trade. The inability to accept the current market situation. And compulsive trading. Drawn to the excitement of the markets. Presence of addiction and gambling issues. Needing to feel that you're in the game. Excessive joy after winning a trade, relating your self-worth to the markets, feeling unrealistically in control of the markets. Next is limiting profits, feeling that you don't deserve to be successful, to have money, or to make profits, usually psychological issues such as poor self-esteem. Not following your proven trading system. You don't really believe it works, you didn't test it very well, and it doesn't match your personality. You're actually looking for more excitement, and you don't trust your ability to choose a successful system. Next is overthinking your trade or second guessing your trading signals. The fear of loss, fear of being wrong, wanting a sure thing where sure things just don't exist. Not understanding the fact that loss is part of trading and the outcome of each trade is unknown. Not accepting the fact that trading imposes risks. Now, not trading the correct position size. Dreaming that the trade will only be profitable. Not fully recognizing the risks and not understanding the importance of money management. Refusing to take responsibility for managing your risks. Trading in excess, the need to conquer the market. Greed, trying to get even with the market for a previous loss. The excitement of trading, which is similar to compulsive trading. Being afraid to trade, no trading system in place, not comfortable with risk and the unknown, or the fear of total loss and the fear of ridicule. Irritability after a day of trading, emotional roller coaster caused by anger, fear, and greed, giving too much attention to trading results and not enough attention to the process itself and the learning the skills of trading, or focusing too much on the money, or having unrealistic trading expectations. Trying to be successful at something, fear of losing your chance of the opportunity, no discipline, greed, and desperation. Now, these are by no means all the psychological issues, but they are the most common. They usually center on the fact that for one reason or another, the trader is not following his chosen trading approach or his system, but he's winging it, or he's succumbed to trading his own emotions. Now, in terms of psychology, your goal is to be on an even keel, so to speak. Your winning and your losing trades should not affect you emotionally. Of course, we all trade better and feel slightly better when we win, but we should really strive to maintain an emotional balance regardless of any gains or losses. The first reason why traders lose may seem quite obvious, but in reality it stems from long-term social conditioning, the inability to accept loss. Loss generates powerful emotions such as fear, uncertainty, apprehension, self-doubt, especially with men. Men are socially conditioned to succeed from the moment they enter the world. They're brought up to become achievers, influenced by their family, friends, education, and career environment. They're encouraged to seek professions such as doctors, lawyers, and bankers, striving to be right, striving to be number one, the breadwinner, and the best, always seeking perfection. Now, men are socially conditioned to be family providers, and moreover, various cultural pressures and demands add to this. And as a result, men end up with an intrinsic fundamental obligation to succeed. The solution here is to take a quick reality check. Losing is part of the game. The possibility to lose is always there. The bottom line is that traders do lose a lot. The how often and the how much is what distinguishes great traders from those that will always struggle. You can learn how to accept losses by redefining the meaning of loss. If you equate it with failure, it will sooner or later take its toll. But redefining it will help you move forward, improve your trading, and cope with possible losses in the future. Consider losing as positive in the sense that it will improve your next trades. Make the mistake a blip on the radar, and don't overreact, and let it come and go with ease. Now, the second important trading challenge is the innate human characteristic of patterns. Here's an example of a trader with a locked-in pattern. He keeps making the same mistake when trading. When asked to describe that mistake, he'll do so in detail. When he's told not to repeat the same mistake again, he'll say he simply can't help it. Although he intellectually knows what he should stop doing and how he can stop making the mistake, he just can't put it together. He keeps repeating it, and as a result, he repeats his losses over and over and over again as well. Here's an example of what a locked-in pattern looks like. You go long, and the market immediately goes down. Then you go short, and the market immediately goes back up. Now, you start shaking and sweating, you get short of breath, and you're ready to throw your computer out the window and jump out yourself. And you've only just sat down to start trading. Now, what's going on? You're in a trading psychology spiral. So how do you break that spiral and that pattern? This is something that I've personally read a lot about, performed a lot of experiments with, and generally desired to learn as much as I can on the topic. Now, the average person can't completely control their mental state. Now, meditation, visualization, and similar practices do definitely help, and I recommend them. And with extensive practice, you can master this side of your mind. But for everyone else, there's one thing that you can control that directly impacts your emotional state and mental state. That's your biology. That's right, it's time to talk food and movement. A lot of your patterns are environmental. For example, if you find yourself getting frustrated every day around the middle of the morning, it's probably a problem with the breakfast you ate, or if you can't control your stress, you might just need to get outside and move. Getting up and moving is the fastest way to stop a pattern dead in its tracks. Go for a walk, a jog, a swim, or hit the gym. The more intense the emotion and the pattern, the longer the separation needs to be. Then come back. But don't start trading yet. You need to do some fixing first. Check if you followed your system. Next, see if your system needs any improvements and then apply them. And stick with your system and accept that days like this do happen. And then trade smaller amounts until you start to make profits again. It's important to avoid bad patterns at any cost and do whatever it takes to break them. Now, thirdly, the biggest and most dangerous of the three problems, which you might already be able to guess by now, is emotion. When a trader gets over-emotional about a trade at any time, he can't think clearly because emotions have taken control over his common sense. Emotions will cloud your judgment, it will block your clear thinking, and it will prevent the trader from being creative. Now, this is how you know you're having an emotional block. You want to trade and also react in a certain way, but you simply can't. And even though you intellectually know what to do, you tend to react differently in that same situation when it comes up again and again. Our emotional strengths and peak mindset are shaped by how and what we think. If we generate bad thoughts, they will affect the overall thinking process. But if we input positive thoughts, the output will also be good. The best way to exclude emotions is to ask the mind a good question. Such questions force the mind to release emotion as the mind shifts to finding the answer to that particular question. And failing that, you're going to need to alter your biology and clear your head like we talked about above. Now, I want to take a quick moment to talk about a classic, Reminiscences of a Stock Operator, which was written in 1923. In trading, your biggest enemy is within yourself. Successful will only come when you have learned to control your emotions. Edwin Lefebvre's Reminiscences of a Stock Operator, the original trading classic, offers advice that applies even today. And here are some of the insights from that book. Caution. Excitement along with the fear of missing an opportunity is often what drives us to enter the market before it's safe to do so. After a downtrend, a number of rallies may fail before we can eventually carry it through. Likewise, the emotional high of a profitable trade may blind us to see the trend reversal. Patience. Before you trade, wait for the right market conditions. At times, it is wise to stay out of the markets and observe it from the sidelines. Conviction. Have the courage to cling to your convictions. Take steps to protect your profits when you see that a trend is weakening, but sit tight and don't let the fear of losing some of your profits cloud your judgment on what needs to happen next. Detachment. Concentrate on the technical aspects rather than the money. If your trades are technically correct, the profits will follow. Stay emotionally detached from the market, avoid getting caught up in short-term excitement, and screen watching is a telltale sign. If you're keeping check of the prices or you're staring at charts for hours, it's a clear sign of insecurity about your strategy and you're likely to suffer losses. Focus. Focus on the longer term time frames and don't try to catch every short-term fluctuation. The most profitable trades are in catching the large trends. Expect the unexpected. Investing involves dealing with probabilities, not certainties. No one can predict the market correctly all the time. Avoid the gambler's logic. Now minimize your losses. Use a stop loss to protect your funds. Once the stop loss is set, don't change it. The biggest mistake you can make is to hold on to a losing position and hope for recovery. We talked about this earlier. The markets have a habit of declining way below what you anticipated, and eventually you're going to be forced to sell, decimating your capital. Human nature being what it is, most traders and investors ignore these rules when they start out for the first time. It can be an expensive lesson, which is why I wanted to teach it to you today, and I really want you to listen to this lesson. You will be more successful when you learn to control your emotions. These are strong words of advice, and the book Reminiscences of a Stock Operator is well worth a read to any trader. Markets change. New opportunities arise and old ones fade away. Good traders are professional but humble people. This is why they keep on learning. Speculators get paid for buying what nobody wants and then selling what everybody wants when everybody wants it. Remember that there's no such thing as a bad trader. On the contrary, there's only well-trained traders or badly trained traders. Be cautious, be cool, be patient. Wait for the right conditions in the market before ever entering your trades. Sit tight when you're losing. Do not let fear grip you. Have courage in your convictions. Detach yourself from your emotions and focus on your trading system. It would also help if you detach yourself from your computer screen. If you've placed your stop loss, it's not necessary to be constantly watching that screen. Don't be afraid to let go of a losing position. The bottom line is that having the right attitude and the right mindset will make you more successful in trading than you ever believed or thought possible. Now that we've talked about the problem, we need a solution. The solution for emotions in trading is not glamorous. It's not a big secret, but it does work. The solution is discipline. And the tools of discipline are your daily habits and rituals, your goals, your trading plan, your trading journal, and your reflection and improvement on all of the above. So that's it for this part of the lesson. You guessed it, we're going to crush that next. See you soon.